According to the New York Times, even your allergist is now angel investing. But your allergist probably doesn't know that those investments could be tax exempt for up to 10 million in gains when they finally bloom. Sound too good to be true? Today we're talking about qualified small business stock, or QSBS. No, not that one. That's the one. I'm Kapoor, and this is FastBreak. FastBreak is my video newsletter where I cover business topics through the lens of media, technology, and venture capital. So the next 4 minutes are going to be about tax law. But before you tune out and scroll past this, there's potentially millions to be gained here, so I promise to make this literally worth your while. Before we begin, a small disclaimer. All right, let's get started. The first thing to know about QSBS is that it's not a new invention. In fact, Section 1202 was enacted way back in 1993, but it wasn't until the Small Business Jobs Act of 2010 that the current exemption took hold, allowing founders, employees, and investors to benefit from QSBS. Here's the headline. The current QSBS tax exclusion allows a shareholder to pay potentially zero in federal income taxes on up to 10 million in gains or 10 times the basis value of the stock if a few conditions are met. Let's split these into seller conditions and buyer conditions. First, how do you know that a seller is qualified? Simple as A, B, C. C, it has to be a C Corp. Sorry, no S Corps or LLCs are allowed. B, the business has to make something. So holding companies, consultancies, law, and architecture firms do not qualify. A, the assets have to be under 50 million at the time the stock was issued. Sidebar, a lot of people misquote the 50 million asset threshold as a valuation under 50 million, but in the case of an asset-light business like a software startup, that threshold could be a heck of a lot higher than 50 million post-money. Second, how do you know that you as a buyer qualify for QSBS? Well, first, you have to be a non-corporate taxpayer. Individuals, estates, trusts, and partnerships, including venture funds, are all kosher. In the case of a VC fund investor known as a limited partner or LP, this exclusion operates on a per LP per company basis, meaning every single portfolio company would be eligible for its own 10 million QSBS threshold. Two, you have to have bought the stock directly from the company. Hedging activities can disqualify QSBS, and secondary shares do not count. Even if you're just warehousing those into a new fund, that transfer of investments will disqualify your QSBS. Three, you have to have held the stock for at least 5 years. Simple enough, right? Well, not exactly. There's a couple of things that can trip you up in your pursuit of tax-free gains. Knowing when that 5-year period starts is crucial. Options, warrants, and convertible debt can be eligible for QSBS, but only at the time of exercise or conversion. What happens when a company gets acquired? Well, a stock-for-stock transaction doesn't eliminate QSBS, but it can limit the benefits. If the acquiring stock is Section 1202 eligible, then the benefit continues. If not, the benefits are limited to the value of the stock on the date of the exchange. Well, what happens if you sell or the company exits within 5 years? The good news is you're not completely screwed. Within 60 days of the sale, you can elect to do a 1045 rollover, literally rolling your proceeds from one qualified stock into another one. For example, if you held stock A for 4 years, and then within 60 days of that exit, rolled it into qualified stock B and held that stock for 1 year, you would qualify for a total of 5 years in QSBS holding of stock B. Pretty great, right? What about safe notes? Well, it depends on the particular writing of the simple agreement for future equity. Since a safe note is not considered debt, nor is it actually equity, under the common safe template, the QSBS clock only starts when you convert into stock. Ideally, you would obtain representations from the company about the safe's treatment as QSBS when you initially sign. Listen, if you're doing a lot of safe note investing, it's time to call your tax pros. Does QSBS benefit LP investors in a fund? The answer is yes, provided you were a member of the fund at the time the investment was made. So if you're one of those LPs that likes to wait until the final close to come into a venture fund, you could be missing out on QSBS treatment for every investment made between the first and final close. It's surprising to me how little understanding the venture community has about the tax implications of equity, considering how much of our upside is tied to that equity's performance. For those who understand it, QSBS is a fantastic incentive to bring more capital into the early stage ecosystem. The bottom line, as the number of angel investors, VCs, and LPs continues to grow, a little bit of attention paid to the QSBS checklist today could potentially lock in millions of savings for years into the future. Until next time, I'm Kapoor, and this is FastBreak. Thanks for watching.